If you are doing business in Kenya, planning for next year's taxes feels like trying to predict the weather in a hurricane. Volatile laws have made it difficult to forecast costs, let alone growth. But the complexity isn't random. The government has transitioned its revenue strategy over the last 2 budget cycles, moving from policy shifts to administrative enforcement. The 2025 finance bill was a targeted hunt for high-value earners. It sought to close systemic tax loopholes used by the largest formal enterprises. The 2026 budget policy statement introduces a different approach, a grassroots dragnet designed to capture the previously invisible income of the informal sector. The nature of your tax risk is evolving. Technical legal interpretations are being supplemented by an integrated nationwide digital surveillance system. To navigate this environment, you must look past individual rules and understand the underlying strategy. Comparing the 2025 and 2026 strategies reveals a clear, predictive playbook for your business operations. This comparison determines whether you need to invest in legal counsel for 2025-era policy disputes or in IT infrastructure to handle 2026-era compliance data. Identifying where the KRA is pointing its resources next allows you to prepare your internal defenses. The 2025 strategy focused on tightening rules for the top tier of the economy, starting with a strict 5-year cap on tax loss carryovers. For capital-intensive projects that take years to turn a profit, this rule cuts off the ability to defer taxes indefinitely. Any losses not exhausted within 5 years simply disappear from your balance sheet. This generates upfront revenue for the Treasury, but it creates a specific hurdle for long-term infrastructure and manufacturing projects that require lengthy recovery periods. 2025 also introduced advanced pricing agreements and began taxing non-resident digital suppliers. These agreements allow Kenya to capture revenue from offshore tech services and bring transparency to transfer pricing within multinational groups. Securing these agreements requires extensive legal preparation, placing the burden of proving fair pricing squarely on the taxpayer before a transaction even occurs. These changes narrowed the legal path for profit shifting, trading future capital incentives for more immediate corporate tax capture. The 2026 side of the matrix shows the state expanding its reach to the rest of the economy. The most direct tactic is the suspension of Nile returns until March 2026. The KRA now cross-references your declared income against your visible economic activity using automated analytics. If a self-employed individual registers a new vehicle or clears an import while filing a Nile return, the system flags the account for an immediate audit. This shifts administrative costs onto small businesses, who must now maintain flawless records to avoid automated triggers. The government is also expanding presumptive taxes, such as withholding taxes on goods supplied to public entities. This focus on the self-employed is documented in the 2026 budget policy statement, explicitly highlighting the compliance imbalance between formal employees and the self-employed. For many earners, 2026 replaces the risk of a technical audit with the certainty of a data-driven mismatch flag. Alongside these enforcement measures, the government is introducing targeted tax relief. The 2025 cycle removed several broad exemptions, but 2026 brings back incentives for very specific activities. We are seeing tax relief on pension benefits and new incentives for green transport and electric bicycles. These measures aim to support the compliant working class and encourage environmental behaviors without draining the Treasury. This creates a conditional landscape where relief is only available if your business or personal spending aligns with state goals. To balance the revenue loss to these exemptions, the state is forced to be even more aggressive in formalizing the remaining informal sector. The scale of revenue mobilization required over the next few years is significant. This chart shows the projected total revenue needed to stabilize the budget. The Treasury's own data suggests that the existing formal tax base is reaching its maximum capacity. Expanding the tax base has become the primary mechanism for meeting Kenya's sovereign debt obligations. The 2026 budget indicates that equity now means ensuring the informal economy contributes at the same rate as formal employees. Map your specific risk profile. For corporations, the risk is technical. Focus on legal structuring to navigate 2025-era rules like the loss cap. If you're self-employed, your risk is data-driven. A nil return is now a high-probability audit trigger. You must prioritize data integrity. Ensure every transaction recorded in ETINs or customs matches the income you report to the KRA. Survival now depends less on legal maneuvering and more on building robust,